Imagine a world where you can quite literally print human organs
Mm.
or craft custom aerospace components with incredible precision.
Or even deliver crucial medical devices right on demand.
Exactly. That's not just sci-fi anymore. It's the ambitious vision driving 3D systems, ticker symbol DDD. They're really a foundational player in this whole world of additive manufacturing.
They really are a pioneer.
Today, we're taking a deep dive into 3D Systems Corporation. We've gathered their latest financial statements, we've looked at their strategic plays, and honestly taken a candid look at some significant challenges they're navigating.
Mm.
Our mission: simple. Give you a shortcut to being truly well-informed about this fascinating company. Understand not just what they do, but why it matters. And maybe, just maybe, where they might be headed next.
Yeah.
Okay, let's unpack this. Is DDD truly on the cusp of a breakthrough? About to print its way to a new future?
Or is it more of an uphill battle, especially in such a fast-moving, competitive market?
That's the question you're about to find out.
It's an incredibly compelling story, isn't it? What's particularly striking about 3D Systems is their deep roots. I mean, over 35 years of experience, they've effectively acted as a pioneering force in additive manufacturing.
Right.
But as we know, even the most seasoned innovators face constant pressure. They have to evolve, adapt, and crucially, perform financially.
Always comes back to the numbers.
It does. So we'll be connecting the dots today between their high-tech, sometimes futuristic solutions, their recent financial health, and the strategic bets they're placing for the future.
Right.
The crucial question we'll be exploring is, how does a company like this balance that groundbreaking long-term innovation, like, printing organs, with the immediate pressing need for profitability? It's a real tightrope walk.
Absolutely, and it's a tension I think we'll feel throughout this deep dive. So to kick us off, who are these foundational innovators at 3D Systems, the company at the heart of this additive manufacturing revolution?
Let's break it down.
Let's trace their journey. They're a global provider, operating through subsidiaries across the Americas, EMEA, and the APAC regions. So worldwide reach. Their offerings span the full spectrum of 3D printing.
Yeah.
You've got the actual 3D printers themselves for plastics and metals,
Right, the hardware.
then a wide range of proprietary materials those printers use. Sophisticated software, like the AUKA manufacturing OS.
Which is key for the workflow.
Exactly.
Yeah.
And essential services to maintenance, advanced applications engineering. But here's where it gets really interesting for me.
The one.
They're not just selling individual pieces of equipment. They seem to be building an entire ecosystem and end-to-end digital workflow solutions.
Yeah, that's their phrase.
Think of it like a complete package. It's designed to help their customers optimize designs, transform entire manufacturing workflows, and ultimately bring innovative products to market faster, more efficiently. It's a very comprehensive approach.
And zooming out a bit, this comprehensive approach is precisely why they've strategically narrowed their focus. They're concentrating on two incredibly crucial industry verticals: healthcare solutions and industrial solutions.
Okay, healthcare and industrial. Makes sense.
In healthcare, they're involved in, everything from dental applications and medical devices to personalized health services. And as you mentioned, even that long-term visionary field of regenerative medicine, truly pushing boundaries there.
Right, the organ printing potential.
Exactly. Then on the industrial side, they're deeply embedded in sectors that demand the highest reliability. Think aerospace, defense, transportation, general manufacturing.
High-stakes industries.
Definitely. Their overarching business strategy emphasizes what they call accelerating additive manufacturing adoption. Now, this isn't just a buzzword.
Okay.
It's about helping customers move beyond just prototyping to actual scaled production. And in doing so, driving those vital recurring revenue streams through the continuous consumption of their materials, software, and services.
Ah, the consumables model. Like printers and ink, but way more complex.
Sort of, yeah. It's a smart move in what's a very capital-intensive industry.
Speaking of ambitious moves, let's pivot to the future. Where is 3D Systems placing its biggest bets for growth, especially in those high-value verticals you mentioned?
Good question. In healthcare solutions, they are heavily, and I mean heavily, investing in regenerative medicine R&D.
That organ transplantation goal.
Right. It sounds like something from a sci-fi movie, doesn't it? But they recently hit a huge milestone in their partnership with United Therapeutics. Actually earned them a $2 million award in the second quarter of 2025 for a new printing breakthrough.
Wow. Okay, so tangible progress, not just talk.
Exactly. Real money, real milestones.
And beyond organ printing. What else is happening in healthcare?
Their personalized health services in medtech are showing real immediate momentum. We're talking solid 13% year over year and 16% sequential growth in Q2 2025.
Like strong growth. What's driving it?
Sure. It's largely driven by the expanded use of 3D printing in complex orthopedic procedures, things like trauma-related surgeries.
Ah, so custom implants.
Precisely. Think custom implants not just for craniomaxillofacial regions, that's the skull and face area,
Right.
but also expanding into spine, knee, and hip markets. The precision and personalization this offers, it's potentially a game changer for patients.
I can imagine. Getting something perfectly fitted must make a huge difference.
It absolutely does. And, it's not just about speed and customization. The regulatory hurdles in healthcare are immense.
Oh, absolutely. That's a major barrier.
Which is why their recent announcement of the world's first MDR-compliant 3D printed facial implant is so significant.
MDR.
Medical device regulation. Achieving compliance means their tech meets the highest safety and performance standards for medical devices in Europe, which is a tough standard. This implant was successfully used in maxillofacial reconstruction surgery at University Hospital Basel.
That's incredible.
And with their specialized EXT220 MED printer, this point-of-care solution, meaning it can be done closer to the patient, potentially in the hospital,
Okay.
has already been utilized in over 80 cranial implant surgeries. They project this specific maxillofacial implant market alone to surpass $4 billion by 2034.
$4 billion. Just for that niche.
Just for that. Gives you a sense of the scale of the opportunity here. It's a very high value, high margin area for them.
That's truly fascinating. That growth in healthcare sounds incredibly promising. But a crucial question arises then.
Yeah.
While healthcare is clearly strong, what's the picture like on the industrial solutions side?
Yeah.
Especially given the broader economic environment we hear so much about.
You hit on a key point, broader market softness. A lot of customers have been more cautious with capital expenditure spending lately. CapEx budgets are tight.
Right. We're seeing that across industries.
However, interestingly, 3D Systems saw remarkable demand in aerospace and defense. Their revenues in this segment actually grew a staggering 84% year over year.
84%.
And 53% sequentially in Q2 2025.
Wow. So A&D is bucking the trend for them.
It seems so. And this isn't just an outlier. It really speaks to their unique positioning. They emphasize their ability as the only U.S. provider of 3D printing technologies to offer a full spectrum of capabilities for these high-reliability components.
What does that mean, full spectrum?
It means from initial process development, figuring out how to print a specific complex part, all the way to supplying the full-scale production printers needed to make lots of them.
Got it. End to end again.
Exactly. They're clearly excited about future growth in these highly demanding markets like A&D, but also newer areas like AI infrastructure, think cooling systems for data centers, and even oil and gas.
Yeah.
Anywhere precise, durable parts are absolutely critical.
Makes sense.
And one point that truly stands out to me is their collaborative spirit. They're not just trying to do it all alone.
Right. You mentioned partnerships earlier.
Yeah. They've teamed up with powerhouses like Penn State, Arizona State, and NASA Glenn Research Center. What are they doing? Developing cutting-edge 3D printed thermal management systems for spacecraft.
Spacecraft tech, like satellites.
Exactly. Imagine creating titanium and nickel titanium radiators that can cut weight by 50% to 70%.
50 to 70% weight reduction. That's huge for launch costs.
Massive. And it simplifies manufacturing for missions like CubeSats, those smaller, more efficient satellites. That kind of innovation directly translates to lower launch costs and greater mission capabilities.
That's impressive. It really shows the disruptive power of this technology when applied correctly. Beyond those technical collaborations, what about their strategic investments? Are they trying to expand their market reach that way too?
Good question. Yes, they also have significant strategic investments to watch. For example, there's the NAMI joint venture in Saudi Arabia with Dusur.
Okay, Saudi Arabia.
Yeah, the aim there is to expand additive manufacturing capabilities in the rapidly growing Middle East and North Africa regions, a geographic play. And then there's an investment in a company called Hatch Inc. They're all about developing an intelligent surgery ecosystem for patient-specific medical devices.
Ah, so that ties back nicely to their personalized health services.
Perfectly. It complements what they're already doing. So yes, while they're definitely facing challenges, they are very actively investing in future growth areas and partnerships. They're not standing still.
Okay, to really understand where 3D Systems is heading, we absolutely have to ground this in the numbers. Let's dig into the latest financials and see what they tell us.
Let's do it. The Q2 2025 results.
Right, reported in August, revenue came in at $95 million. Now, at first glance, that's a 16% decline year over year.
Which sounds pretty bad initially.
It does. And that's largely due to that soft customer capital expenditure spending and maybe some tariff uncertainties we talked about.
Right, the macro factors.
And however, and this is a key insight here, it actually showed impressive 8% sequential growth from Q1, if you exclude the sale of their G-Magic software business.
So quarter over quarter, things picked up.
Exactly. That suggests maybe a promising recovery within the year. And the good news doesn't stop there. Net income actually benefited from improved operating performance.
Okay.
Plus, gains on that Geomagic sale helped the bottom line, and they made some smart moves in debt extinguishment.
Cleaning up the balance sheet a bit.
Seems like it. And on top of that, those cost reduction programs we mentioned earlier, they delivered over $20 million in savings in Q2 alone.
$20 million in one quarter. That's significant cost cutting.
It really is. So yeah, a mixed picture financially for the quarter, but with some definite green shoots maybe.
It's crucial, though, to put those quarterly results into a broader context. If we connect this to the full year 2024, the picture becomes a bit clearer in terms of the underlying trends they're fighting against.
Okay, so what did 2024 look like overall?
Well, total consolidated revenue decreased by nearly 10% year over year. It came in just over $440 million, down from around $488 million in 2023.
So a definite contraction for the full year. Where did the hit come from?
It was primarily driven by a roughly $50 million decrease in product revenue, the actual printers and materials. It hit certain industrial solutions like jewelry, consumer auto, academic markets, and also saw a dip in some healthcare solutions, particularly dental and maybe some medical devices.
But what about services? You said that was growing.
On a brighter note, yes. Services revenue actually saw a slight increase of 1% to just over $160 million, mainly driven by their industrial segment clients needing support.
So services are holding up better than product sales.
Relatively, yes. But overall, gross profit for 2024 took a hit. It was down about 16% to $164 million. And the gross profit margin shrank from just over 40% in 2023 down to about 37%.
Margin compression, not what you want to see.
Definitely not. Now, looking at the bottom line for 2024, the net loss was still substantial at around $255 million.
Still deep in the red then.
Yes, though it was actually an improvement from the $362 million loss they posted in 2023. So the loss narrowed. Their basic loss per share stood at $1.
Okay. And cash flow, are they burning through cash?
In terms of cash flow, operating activities used about $45 million in 2024. Now, that's still negative they used cash, but it was a significant improvement from the $80 million used in 2023.
So they slowed the burn rate. Yeah.
Largely thanks to efforts in inventory reduction and just better working capital management overall, getting more efficient.
And their cash position at year end.
They ended 2024 with a healthy $171 million in cash and cash equivalents. And their balance sheet shows short and long-term assets comfortably exceeding liabilities. That provides a cash runway for, well, probably more than a year at current rates.
Okay, so they have some breathing room.
They do. So while the past year showed a contraction in revenue and persistent losses, there's clear progress on improving efficiency and managing cash burn.
It's clear they're actively addressing these challenges then. I mean, they implemented that 2023 restructuring plan designed to improve operating efficiencies.
Right. That involved bringing European metal printer operations in-house, headcount reductions, and rationalizing their geographic footprint, getting rid of excess facilities.
And they made progress on that.
Yeah, they successfully completed exiting 19 leased facilities identified in that plan by the first quarter of 2025. So they followed through.
And they're not stopping there, are they? There was another plan announced.
Correct. In March 2025, they authorized a new 2025 restructuring plan. This one specifically targets sustainable growth and profitability. More streamlining. Seems like it. Further streamlining of their infrastructure and business processes. They expect significant annual savings to kick in this year from this new plan.
And they have a goal for profitability.
Their stated aim is to achieve positive cash flow by 2026. That's the target they've set.
That's ambitious.
It is. And this also involves a strategic reduction in R&D spending. They're planning to bring it down from roughly 20% of revenue, which is quite high.
Yeah, that is high.
Down to the mid-teens. Clearly prioritizing projects with more near-term return potential. So, yes, they're really tightening the belt across the board.
Makes sense if cash flow is the immediate priority.
They absolutely are focusing on that. And this proactive restructuring is critical because they're navigating some significant financial complexities beyond just the operating losses.
Like what?
Well, for example, their debt load. They had approximately $214 million outstanding in 0% convertible senior notes due in 2026 as of the end of 2024.
0% convertible notes. How does that work?
It's a type of debt. Essentially, they borrow money but pay no periodic interest. Instead, the lenders typically have the option to convert that debt into company stock later on, usually if the stock price goes up. It can be a cheaper way to raise capital if you expect your stock to perform well.
Ah, okay, so it depends on future stock performance. Was there an issue with those notes?
They did face a brief period of non-compliance with certain terms in the agreement, the indenture, due to delayed SEC filings back in Q2 2024. But importantly, they successfully cured those defaults.
Okay, so they fixed that problem.
Yes, which is a positive sign they're getting their house in order administratively.
But weren't there other issues mentioned in their reporting? Something about internal controls?
Yes, and this is quite serious. Their 2024 financial report disclosed material weaknesses in internal control over financial reporting as of the end of 2024.
Material weaknesses. That sounds bad. What does it actually mean?
It's not just accounting jargon. It means there were significant deficiencies found in their processes, specifically related to how they recognize revenue, the valuation assumptions they use for intangible assets and goodwill,
Okay.
their financial close and reporting processes, and how they account for complex transactions.
So basically, fundamental accounting and reporting processes had flaws.
In practical terms, yes. It means there's a higher risk of financial misstatements occurring and not being caught promptly. That's something investors, understandably, watch very closely.
Are they fixing it?
They've outlined a remediation plan. It involves enhancing controls, hiring more people with the right expertise, and bringing in external consultants to help overhaul these processes. But remediation takes time and effort.
That's a serious flag. Definitely suggests a need for fundamental operational improvements. But another aspect that caught my eye in their financials was the sheer scale of their asset impairments. Can you break down what that means for us and why it's so significant?
That's a very astute observation, and it's perhaps one of the most telling indicators of, well, maybe past strategic missteps or maybe overvaluations during acquisitions.
Impairments, so writing down asset values.
Exactly. In 2024 alone, they recorded a substantial $101.4 million goodwill impairment related to their healthcare solutions reporting unit.
$100 million just for healthcare goodwill.
Yes. And an additional $42.3 million impairment for long-lived assets in core operations.
So what is goodwill technically?
To put it simply, goodwill is often the premium a company pays when acquiring another company above the fair value of its identifiable net assets. It represents things like brand reputation, customer relationships, synergies, intangible value.
Okay, so an impairment means...
An impairment means they've essentially had to write down the value of these past acquisitions or assets on their books. They're acknowledging that the future earnings or cash flows expected from these assets are now projected to be less than they originally thought when they acquired them or invested in them.
Ah, so it's an admission that past bets haven't panned out as expected.
It can be interpreted that way, yes. These significant charges are a stark reflection that reduced long-term cash flow forecasts, and frankly, the decline in their own stock price forced a necessary reset of how the company values its future prospects and perhaps some past strategic decisions.
And this wasn't the first time, right?
No, it wasn't an isolated event. This follows an even more substantial $279.8 million goodwill impairment charge taken in their industrial solutions segment back in 2023.
Wow. Nearly $280 million there, too.
Yes, along with impairments of IPR&D, that's in-process research and development, projects not yet completed, and a portion of their Optin manufacturing OS software value as well.
So across both major segments, significant revaluations. It really indicates a challenging period of asset recalibration.
That's a good way to put it, recalibration. Beyond these internal financial and operational issues, they also cite, the usual suspects, external macroeconomic trends like inflation, rising interest rates.
Geopolitical tensions.
Right. Ongoing supply chain disruptions, potential product quality issues, always a risk in manufacturing, and of course, cybersecurity threats. These are persistent risks for any global tech company.
And the stock price reflects these challenges.
Unfortunately, yes. If we look at their stock performance graph provided in their reports, it shows a pretty steep decline from around $100 on December 31st, 2019, down to $37 by December 31st, 2024. It's significantly underperformed broader market indices over that period.
That's a tough ride for long-term shareholders.
It absolutely is. However, it's also worth noting that they do have an experienced management team in place trying to navigate all this, including the founder, Charles W. Hull, who's still involved as EVP and CTO for regenerative medicine.
The original inventor.
The original inventor, yes, alongside newer executives with backgrounds from other large publicly traded companies. They're the ones tasked with overseeing these complex operations and leading these critical remediation efforts for internal controls and restructuring. It's a group with a lot on its plate right now.
Understatement of the year, maybe. So let's try and synthesize this. What does this all mean for you, our listener, as an informed observer trying to understand the latest updates and future potential of 3D systems?
Where do we stand?
Well, this is clearly a company at a crossroads, no doubt about it.
Right.
On one hand, they are genuinely leading innovation in critical high-growth sectors like healthcare and aerospace. They're pushing boundaries that honestly almost feel futuristic sometimes.
The organ printing, the spacecraft parts.
Exactly. They're making bold moves in regenerative medicine and high-reliability industrial applications. These are backed by strategic partnerships and now a very clear plan to cut costs and achieve that positive cash flow target by 2026.
So the forward-looking story is exciting.
It is. Yet, simultaneously, they are aggressively restructuring and tackling really significant financial complexities. We're talking material weaknesses in internal controls, these huge asset impairments.
The baggage from the past, perhaps?
Maybe. And all of this comes against that backdrop of external macroeconomic pressures and a stock that has seen a substantial decline over the past 5 years. It's a real duality.
If we connect all of this to the bigger picture, 3D Systems' journey really reflects the broader maturation of the entire additive manufacturing industry. It's growing up, facing growing pains.
How so?
Well, the question now for investors and innovators isn't just about printing cool parts anymore. It's about printing a sustainable and critically a profitable future amidst rapid technological change and really intense competition. It's not enough just to innovate. You have to make money doing it.
Right. The business model has to work.
Precisely. And this raises, I think, an important question for reflection. Can their strategic focus on those high-growth, high-value applications in healthcare and high-reliability industrial markets, can that focus ultimately offset the foundational financial challenges and these significant impairment charges we've seen in recent years?
Can the future pay for the past and present struggles?
That's the essence of it. What aspects of their story do you, the listener, think will be the most critical for their long-term success? Is it the tech, the restructuring, the leadership? It's a complex equation, isn't it? And the next few years will certainly be telling for DDD.